Let's reconvene on this home stretch of asset liability management processes and methodology. So who goes first? Mr. Cohen?
Yes, I can take that, President Jones.
Okay.
Thanks everybody. I think the Wilshire guys gave us a good introduction, bringing up the asset liability management process several times. So the purpose of this session is really just to give you an overview of what the process is, what the timeline is, and what the responsibilities of my office, the actuarial office, and the investment office are. So we've got a couple slides if we can pull those up that'll just help us go through this. But overall, the asset liability management process is really our effort to make sure that our assets are linked to our liabilities long term. And ultimately, at the end of this, as you kind of already heard, it leads to an asset allocation and the discount rate. So if we go to the next slide, you'll really kind of get a sense of the timeline of what we're looking at. You'll see here that this is sort of the beginning of the process, but calendar year 2021 is really the key year for the ALM process, as we like to call it. We do this process every 4 years, and the reason for that is that we don't want to make any large swings. So the 4 years kind of gives us a routine opportunity to continue to check in and make sure that we're on track and make any minor adjustments as needed go along way. So really, as the chief financial officer, I'm the one who coordinates the process between the actuarial office and the investment office. The reason for that is to make sure that we do have good coordination, good communication, and that nobody goes back into a silo and doesn't know what the other office is working on. So with that, if we just click to the next slide for a second, it kind of gives you an overview of what each of the offices does, and we'll get into this more over the next few minutes with the investment office and the actuarial office. I'm really the coordinator, as I mentioned, and then the stakeholder relations and communications unit will make sure that all the way through the process that our stakeholders have an opportunity to understand what's happening, where are the opportunities for engagement, which there are many, and then communicating back out the key decisions and make sure that everyone understands what's going on. So I think as we go through this, it might be easiest if we go back to the timeline, the previous slide, and I'll go ahead and start with the actuarial office, Scott Trando, and just sort of kick it off with a real basic question in terms of, Scott, can you talk about the actuarial office's activities that contribute to the ALM process and what we can expect over the next year or so?
Sure, thanks, Michael. As Michael mentioned, this is an all-encompassing project that's going to occur over the next year or so. And, our office works in conjunction with both the investment office and the financial office during this time. Some of the primary things that the actuarial office is involved with is working on I would say, the long-term economic assumptions and the demographic assumptions. So let's start with the economic assumptions first. Some of the primary work that we will be doing is we'll be working with the investment office and forming the long-term expected capital market assumptions. As you heard previously from Wilshire about the capital market assumptions, we get this from the investment office. They concentrate on more of a short term, and what they consider long term as being 10 years. For the actuarial office, 10 years is short term, 20 years is like a medium term, and getting out to 30, 40 years is more of a long term expectation on our side. So we work, and our goal is to develop those capital market assumptions on the various asset classes on a long term basis. We are also working on the inflation assumption, again, more on the long term basis. These two assumptions, used in conjunction with the shorter term capital market assumptions, are a primary driver for the discount rate. As you know, the discount rate is what we use to bring back all the projected cash flows and is a key driver in terms of a lot of the contributions that the employers make. On the demographic side, what we do is we do a review of all the demographic assumptions used in the retirement system. We do that every 4 years. The review's not only required by law, but it's also part of our professional standards. The goal of the review is to look at such things as mortality, rate of retirement, disability, terminations, and other factors like that. And a lot of these various assumptions have a very large impact on the costs that get charged for the employers. You know, the goal that we have here with the assumptions is we want to make sure they reflect reality and basically reflect the experience that the plan has seen, but also we want to take into consideration any trends that we see going on as well. These two things I think are some of the bigger drivers driving the contributions for the employers, and we want to make sure that we do our best to, the expectations are, we won't always be right, but we want to be fairly close on average to the rate, so employers aren't contributing too much or not contributing enough to fund the benefits.
Thanks, Scott.
Yeah.
Do you want to go into a little bit more detail on the types of scenarios that you'll be preparing for the board in terms of, you mentioned longer term, kind of up to 40 years. So can you give us a little bit more about the scenarios that you?
Sure. So on the investment side, we work with the investment office and we generate thousands of various investment rate return scenarios. And these go out 30, 40, 50 years. And what we do is we run all these scenarios and they reflect, up markets, down markets, spikes. We try and take into consideration changes in inflation and different, economic scenarios. Based on all these different scenarios, we try and come up with key measurements for the system. We look at funded status statistics in terms of where do we see the funded status of the plans going, and we look at the probability of the fund dropping below 50% or 60%. What are those chances under all these scenarios? So then we can get some judgments on where various portfolios would put the system at. We look at contribution rates. We look at the ranges of contribution rates under all the scenarios. We look for spikes within the rates. Will a high volatility portfolio cause high rates in particular cases, or do we end up getting better returns with and not as much volatility? So we take all those in consideration. We develop some statistics based on the probabilistic returns of all those, and then all those kind of flow into the analysis that's presented to the board during the ALM cycle when we see the various portfolios given, and the board can see, from what we're seeing is the different impacts that the various portfolios can have on the system as a whole.
Thanks. Let me ask you a question that you wouldn't have been asked 4 years ago. So obviously we're in a pandemic. We're not sure, as we've heard, how long this is going to last, but how do you see COVID-19 sort of affecting your workload through the ALM process and your process of performing the ALM work?
Well, I want to say that our actual office has stepped up in terms of being able to deal with it, deal with the crisis. They've been able to continue their work and meet their deadlines, doing everything remotely. And while it's going to be a challenge doing things remotely, we're up to it seems that we expect to be up to the challenge. We don't anticipate any additional hurdles that we shouldn't be able to overcome through remote. So in terms of processing, it'll be different, but we expect to be able to get through it, meet everything on time, and be thorough without having to take any shortcuts through the process. Now, in terms of if you think about what COVID may have on the results of those studies, for us this year, when we do the experience study, our data set is going to be through June 30th of 2019. So there's going to be not really much of a reflection in terms of the results of COVID-19. We do take projections into consideration, and those are based on the Society of Actuaries, as well as sometimes Social Security Administration. And to the extent that their projections include some of those impacts, they will be included in our projections as well. We anticipate most likely not in this ALM cycle, but the one 5 years from now, we'll have more results, and those results will factor into the actual results when we do the experience study analysis.
Good, thanks. I've dumped my headphones, so hopefully the sound is much better. Anti-technology. Here's a good spot to pause. I think we had a question, Mr. President, if you're okay, we can go ahead and take the question now, and then we'll move on to the investment office.
Mr. Rubalcaba.
Thank you, Mr. Jones. I think Michael sort of started that conversation I was going to have. So, you mentioned, Scott, the demographics is a big indicator that impacts the rate of return or the discount rate. You guys use here, but then you said it's not going to be 5 years time. For example, retirement projections might be impacted by this COVID-19, I would assume. I mean, then the whole thing about demographic change, because I'm still trying to get used to the 4-year timetable. I'm used to a 3-year timetable in the 37 Act. So, but it's too early to say what the impact would be. I guess is what I'm trying to say.
Yeah, that's the challenge right now. Is right now, on the mortality side, it's very difficult to see what kind of impact that's going to have. And like you mentioned on the retirement side, that's always a challenge. The furloughs or the PLP days that the state employees are having definitely can have an impact on when people retire. We ran into this on various times before when either you'll see a spike 1 year in retirements, but then it brings just the if you think about if people retire earlier this year, they're not around the following years to retire. And when we look at our analysis, we don't just look at 1 year's worth of data. We look at 10 years and 20 years worth of data, and we look at trends. And so you may see a spike in 1 year followed by a drop off in the subsequent year. And so we try to we want to try and kind of smooth out those ups and downs and try and get somewhere where it's a more reasonable estimate of where we anticipate the say, for example, retirements end up being.
Yeah, thank you. I have one more question, Mr. Jones.
Yeah.
A lot of employers are doing early retirement incentives, golden handshake. So that would impact the demographics and the experience study on the projections, and also would impact the benefit costs and the revenue coming in, because as people get replaced earlier than projected, they'll come in on a pepper tier. So that would change everything, wouldn't it? But it's still getting a little too early to project. But it is also something we need to look forward to, right?
Definitely. When employers do go on handshakes or early retirement incentives, there's a trade-off. They're trading off reducing payroll right now for retirement benefits, and those will have an impact on the retirement system and higher liabilities going forward. So it's somewhat of a trade-off. And where that ends up, it's we kind of have to wait to see how that plays out with the employers. But we do take that into consideration, and also during our projections, we try and look at how the increase to PEPR members is progressing. We have various. We can look at a number, either the state, or particular public agency, and see how fast the PEPR members are increasing over the overall population. And we can make some adjustments to those projections and see how future rates will trend down, especially on the normal costs as the PEPR membership increases over the years.
Thank you.
Okay, continue.
All right. Thanks, Mr. President. So now we're going to turn to Christine Reese from the Investment Office, who's going to sort of give us a sense of how the Investment Office approaches the ALM process. So Christine, you want to take it away and give us an overview of what your workload looks like from the Investment Office standpoint?
Yes. Just confirming you can hear me, Michael?
Yes, you sound great.
Okay, perfect. Thank you. So yes, thank you I appreciate the opportunity to participate in today's panel. As you mentioned earlier, the entire process is a highly coordinated effort between our teams, the investment, actuarial, and financial offices. The focus of the investment office in the ALM process is evaluating the asset side of the equation using strategic asset allocation, and then working with the actuarial office to bring that together with the liability side of the equation, as well as working with your team, Michael, the financial office, through the Asset Liability Management Advisory Committee on coordination, communication, and outreach, and management of the overall process. Within the investment office, many teams and individuals will make significant contributions to the ALM work during the next few years. And there are many activities in which we will engage. And I do want to say here that Wilshire laid a lot of good groundwork, because I will be mentioning certain topics that they've already discussed in detail. So they've laid some groundwork for our item, which is great. So if we're looking at the timeline, I'm going to break down the investment process into kind of three broad categories. So first is a market assessment, wherein we would review what the market has to offer for investable asset classes and their associated capital market assumptions, which, as Wilshire mentioned, are risk, return, and correlations. So this work incorporates research on topics such as individual asset classes, so private debt as an example, research on CMA models, leverage, liquidity, investment strategy, and portfolio construction, to name a few topics that we conduct research on. This research is currently underway and is ongoing within the investment office. Apologies, I lost my headphone. It's ongoing within the investment office, which enables us to continually evolve our process as the investment landscape changes over time. The recommended capital market assumptions, which are an output of that market assessment, will be brought forward to the board in June of 2021. Second element of the process is a risk assessment, and that's an evaluation of acceptable risk to take within the investment portfolio based on the unique characteristics of each fund, so PERF and each of the affiliate funds. Examples of some of those characteristics that would have an impact on risk tolerance are the funded status, what cash flows look like in terms of contributions and distributions, what the liability time horizon is, and the maturity of the fund. And risk tolerance will be a topic of great discussion at the board offsite in July of 2021. And then the third area is portfolio construction, selection, and implementation, wherein we evaluate and present diversified candidate portfolios that are believed to best balance the estimated investment risk and returns with the liabilities of the funds and matched with their time horizon. So that portfolio construction process balances out the capital market assumptions with the risk tolerance to produce the efficient frontier, which Wilshire talked about. And from that efficient frontier, the candidate portfolios can be evaluated and then stress tested. We will be bringing the proposed candidate portfolios to the board in September of 2021. And then the final selection for the portfolios as well as the discount rate would be in November of 2021. And then I would just like to note that implementation will begin in July of 2022. And depending on the final asset allocation and how much transition activity needs to occur, the timeline for that implementation will vary. So with that, back to you, Michael, for the next question.
Sure. Thanks, Christine. So same question I asked Scott. How do you see the pandemic changing or not changing at all kind of the investment office side of the ALM process?
Yeah. So not to sound like a broken record, but much to what Wilshire has mentioned is that, you know, COVID-19 is likely to have a long-term impact on many aspects of economics and investing, such as economic growth, labor markets, productivity growth, as well as corporate and consumer behavior. The type and severity of the impacts are difficult to forecast. The pandemic continues to evolve with successes as well as setbacks. With this high level of uncertainty, we don't know how long the pandemic will last, when a vaccine might be available, and you know how much more monetary and fiscal policy aid will be available as we move forward, as well as not really knowing at this point how long it will take for the U.S. and global economy to recover. From purely a process perspective, as Scott mentioned, we believe in the investment office that the impact should be minimal, and that we are successfully working remotely on both the day-to-day investment management of the portfolios, as well as moving strategic initiatives forward. So, it will be different from ALM studies in the past, but we have every reason to believe that we should be able to get through it, on time and working well with the actuarial and financial office teams. From an investment perspective, we just don't know. When we start our market assessment at the beginning of 2021, we'll just have to evaluate at that time. We do expect market volatility to remain high, and that the various asset classes that we evaluate, may see different impacts as well as levels of severity. It's difficult to say much more than that, but as a long-term investor, we will evaluate the information that's known to us at that time and work to build a strategic asset allocation that keeps our long-term investment horizon in focus. Back to you, Michael.
Good, thanks. Do you want to, so the board, you just brought back last month in June, sort of the mid-cycle review of the ALM and the capital market assumptions. Do you want to kind of put that in perspective in terms of how that was closing off sort of the last ALM cycle and so forth?
Yeah, I mean, you can kind of look at it two ways since it's the midpoint. It's a review of the asset allocation that we have in place and looking at the capital market assumptions. Obviously, major changes from even 6 months ago. It can also be looked at as a view forward. So when we do the mid-cycle evaluation, when we do the assessment, we find areas that may deserve further study as we move into preparing for the cycle to begin next year. So some of those areas are being researched now, and then I'm going to pause on saying anything more about CMAs as Diane Sandoval and Allison Lee are going to be presenting that in the final session today.
Great. Well, let me just make some final wrap-up comments, and then I can turn it back to you, Mr. President, to see if there's board member questions or comments. Overall, the ALM process is sort of a very transparent process. In fact, it's guided by a board adopted policy. The last time the board adopted that policy was back in 2017. So we will be bringing that to you later this fall for re-review. Right now, we're expecting a number of technical amendments, but no major changes. But that is something the board can expect to see in the coming months in terms of a review. Overall, the key points I think are, as you can see throughout this process, we'll be doing all of these conversations in public, welcoming our stakeholder and our member feedback to that, and coordinating among the three offices is very key. We want to make sure, and this is really, I think, what distinguishes us from some other pension systems, is the level of coordination that the three offices do to make sure that all of the assumptions are consistent and that it sort of works internally together. So with that, Mr. Jones, I'll turn it back to you.
Okay, well, we want to thank the three of you for your presentation and setting forth and providing that timeline and about the process. So thank you very much.